When I'm deciding how to roll a cash secured put, I always run the numbers, and the most helpful number is the annualized rate of return. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals. The annualized rate of return lets me compare different expirations and strike prices on equal footing. A $200 premium over 2 weeks might be better than $350 over 6, but without annualizing, it's sometimes hard to tell. In this NVDA example, I'm looking at several possible rolls, 3 different expiration dates, and 3 different strikes. I'll walk you through the numbers so you can see how the annualized return formula helps guide my decision. Closing the current open put is going to cost about $6. So for each of the options that we consider, I'm going to subtract $6 before I enter it on the spreadsheet. Going out to May 2nd, a 7-day roll, a $105 strike would bring $147. So I'll enter $141 on the spreadsheet. For the $102 strike, I see a price of 80 cents a share, so I'll enter 74. And the $100 strike right now has an offer of 55 cents a share, so I'll enter 49. Now let's look at May 23rd with the same strikes, but now a 28-day roll instead of a 7-day roll. 364, 266, and 220. And if we roll out 56 days, all the way to June 20th, 629 and 514 and 454. Because the value of the options contract tends to erode much more quickly in the last few days of the contract, you can see that the highest annualized return is for the $105 put expiring in 7 days. That's a 70% annualized return. But the total premium brought in is much lower than a comparable roll out to May 23rd or June 20th. So I could bring in for a $105 roll $142, $364, or $629. But because of the longer holding period, this 56-day roll has an annualized return of less than 40% compared to 45% or 70%. Likewise, looking at the $102 roll, the possible income could be $74, $266, or $514. The annualized return would be just under 38% versus 34%, or just under 33%. And with the $100 roll, a 1-week roll would bring in $49 with an annualized rate of return of 25.55%. The 28-day roll actually has a higher annualized return with almost 29%, and the June 20th roll to the $100 strike has close to a 30% annualized return. So here's what this comparison shows. The annualized return gives me a powerful way to evaluate how effectively each roll uses my capital, but it's not the only factor I consider. I also think about, do I want to avoid assignment? Do I want to exit the trade entirely? Am I just trying to collect a bit more premium to offset my cost basis or improve my bottom line? That said, the annualized return is what gives me clarity. It helps me weigh the trade-offs, the strike price, the time, and the risk. Without it, I'd just be guessing. I don't always take the highest rate, but I always know what I'm giving up when I don't. If you want a deeper look at how I use the annualized return formula to manage trades, there's a full chapter on it in my book, Beginner's Guide to Safe Options Trading. I go step by step through the math, but more importantly, I explain how to use the numbers to make smart decisions when you're rolling, whether you're trying to avoid assignment, reduce risk, or just improve your bottom line. You can grab it on Amazon for $4.99, and I'll drop a link in the description.